Welcome to Tax Notes Talk, a podcast from Tax Notes, the leading source of tax news, information, and analysis.
Happy New Year from Tax Notes. I'm David Stewart, Editor-in-Chief of Tax Notes Today International. This week, State Status Report 2023. As 2022 wraps up and people around the world prepare for the new year, we're looking ahead to see what 2023 may bring for tax policy, specifically for states here in the U.S. There are many issues to keep an eye on, and here to talk more about some of the most important ones is Tax Notes senior reporter Paul Jones. Paul, welcome back to the podcast.
Hi, David. It's always a pleasure.
Now, you recently spoke with someone about some of the key issues facing the states. Could you tell us about your guest?
Yeah, sure. I spoke with Valerie Dickerson, who's a partner with Deloitte Tax LLP, and whose practice area focuses on multi-state tax issues.
And what sort of things did you talk about?
Well, we discussed a range of notable issues that states are likely to address in various ways next year, from new regulations for pass-through entities, transfer pricing rules, and even incentives for semiconductor companies related to the CHIPS Act.
All right, let's go to that interview.
Valerie, thanks for taking time to talk with us.
My pleasure. Thanks for having me, Paul.
Yeah, so what are some of the issues that you think are likely to get either new or renewed attention in 2023? We spoke previously. I think one of the things you said there's some growing interest by states in looking into is developing new or more detailed or specific rules for taxing large, complex, multi-state pass-through entities, things like better definitions, clearer sourcing rules, et cetera. Can you talk to us about what states may be doing in 2023 on this issue?
Thanks, Paul. Yes, absolutely. The pass-through area, I believe, is an area where we will see continued development. And as you just mentioned, that those are probably some of the areas. But we've seen, the multi-state tax commission start to poke around investment partnerships. We have seen some starting of defining terms in that area. We see New York's issuance of draft regulations around sourcing for certain investment partnerships or investment management income. And then we see California having issued a couple of legal rulings around certain sourcing issues for partnerships, as well as a surge in litigation at the Office of the Tax Appeals level in California. And so I think California and New York are the states that seem like they have already and are likely to continue to take the lead. And seems like we'll probably start to or continue to see some developments with the MTC as well.
Right. And, California and New York, obviously large states, the MTC is pretty influential. Are the developments that we're seeing with those states likely to sort of clear a path for other states that want to follow suit? Or are the situations faced by California and New York, the types of businesses and multi-state entities that are operating in them, is that something that's not necessarily going to translate to other states in the US as easily? I guess what I'm trying to ask is, are we seeing the foundation being laid by these two large states in the MTC for what other states may be able to just sort of copy and paste? Or is this going to be a longer effort with states coming up with their sort of more bespoke solutions to this problem going forward?
Well, it's certainly not an area of issue that's only for these two large states. Certainly the other states are going to be interested in what is happening in these two states, but also interested for their own sakes in what is going on in this area. While I mentioned California and New York, there have been cases developing in a number of other states, Massachusetts, Illinois, Ohio, and others. And that's probably just a fraction. And I don't know that I would say that anyone's going to want to copy and paste what California or New York will do, but just the fact that they are doing something and more guidance is probable, I think does raise the interest level of the other states and makes it potentially more likely that more guidance will come out from those states as well.
Correct me if I'm wrong, but when we spoke previously, I think I suggested that maybe the new audit regime rules that states, some states at least, have been moving to conform to may have created sort of an opening for states to start looking at how to better tax these pass-through entities. Do you think that that's correct? And is that influencing the timing of states taking an interest in this? Obviously, for a long time, states have focused a lot on corporations, corporate audits, et cetera. But why is there now a focus on developing rules to address these larger and more complicated pass-through entities?
Yeah, it's a great question. And I would say, sort of yes, and certainly with states needing to have a way of dealing with the outcome of the BBA audit from the service, and a number of states have started to adopt some rules and some skeletal rules, and the MTC took a stab at it. I think did highlight and sort of make the timing more now. Although, in some situations, and probably the two lead states we've already mentioned, there's been an awareness that the states have been interested already. But I do think that the timing has kind of come into being, probably because of what has happened at the federal level with the BBA audits.
And so again, focusing on 2023, is this something that we're going to be seeing play out much in the legislature, or is this mainly going to be something that progress on it is made by departments of revenue promulgating rules and tax controversies with commissions and courts issuing rulings that help sort of shore up which definitions or approaches, for example, to sourcing are appropriate?
Well, honestly, some of the issues are complicated. I mean, some of the issues with how you're going to report and what entity or partner gets adjusted from a BBA perspective is not necessarily, cut and dry. I mean, there's a lot to think through here, but there's a lot to think through in terms of definitions. And I guess I would say from an ideal perspective, it seems to me that legislation would certainly need to be undertaken if any kind of policy change is going to be evidenced, or a change in how these matters are analyzed. That being said, already we've seen California and New York start to put some things in writing in terms of guidance. And I suspect that we'll see some more policy thinking get put into writing at the administrative level before we see legislation. That's a guess on my part. And, there's always that balance of needing to be within the confines of what the statutes actually say when that guidance does get issued.
So definitely something to keep an eye on. And on the topic of pass-through entity rules, I think we should also probably note that there's obviously been a lot of states that have adopted the sort of pass-through entity type workaround to the SALT cap from the Tax Cuts and Jobs Act. And subsequently, there's been some effort by states to sort of address various issues, make some tweaks to them. But I guess looking forward now in 2023, you have maybe, I think, half the states have such workarounds. Do you think that there are going to be more that adopt them? And of those that have adopted them, what do they need to do now? The legislation's done. There may be some statutory tweaks that they put out in the coming year. But in terms of if you're a taxpayer that's interested in utilizing this workaround, what do you still need from these states in order to figure out if this is going to be the best approach for you to take?
So a couple of questions in there. I would not be surprised to see some additional states take up the pass-through entity elections, especially with the service sort of okaying it, if you will. In terms of what the states may do, I suspect that as the positions are taken and returns are processed and potentially audits happen, and there will be some tweaking that needs to happen that will be discovered and done. Whether it needs to be done legislatively or administratively, I think it's going to be a little bit case by case. In terms of taxpayers, I think taxpayers are going to find themselves in the position of needing guidance. I mean, true to state and local taxation, there's some uniformity, but not true uniformity in how many of these were adopted. And so taxpayers that might be in the situation, paying in multiple jurisdictions, they're going to be looking for some continuity, which is always, a desire in order to make the administrative processes more efficient. So I do think the taxpayers will probably be looking for additional guidance, or would want the dates to line up, or just be more clear about what's in or what's out and what the impact is, both at the entity level and partner level. So I think we'll continue to see some tweaks, whether they're coming at the request of taxpayers or whether they're coming administratively.
Yes, and one comment that I've heard from a number of practitioners is that they are concerned that these states' tax credits that are provided to the partners or members of pass-through entities are written in such a way that they may not be recognized by another state when that state is trying to determine, how much tax to offset for a partner or a member that they paid in that state versus another state. So is there an issue with, now that we're shifting the incidence of the tax to the entity rather than the actual recipient of the income, is there a need for states to ensure that there's some reciprocity there so that people are able to use these workarounds without endangering their situation in another state?
There's always been a little bit of inconsistency around how states apply the other state tax credit on an individual basis. So what you suggest in terms of, is there going to be potential leakage between states in how terms are defined or understood, or what's it understood to be acceptable at the entity level? I do think is, at least in some limited number of states, probably going to come to the forefront to a certain degree.
And last question on this topic. Obviously, the Tax Cuts and Jobs Act, a lot of its provisions expire within a few years, including the SALT cap. But of course, it's important for taxpayers to get certainty as to how this workaround applies for the years that predate that. But isn't it also the case that there may be some suspicion amongst taxpayers and practitioners that the SALT cap will ultimately become a permanent feature?
Yeah, I mean, I think that's kind of what the states will need to decide, is how much they want to invest in tweaking something that may or may not go away. And I'm not sure that I could speculate, but it seems like there is a possible scenario in which, for whatever reason, it is favored by some or enough in Congress to want a salt cap to stay around, or that, it's representative of something that's needed or not ready to be negotiated, and then perhaps it stays in. So I think it's just impossible to know right now whether or not that expiration, really will come to pass. Maybe it will, and maybe you don't overinvest in making it perfect, but maybe it stays. And so I imagine that to some degree that is maybe why some states are a little less inclined to be first in line around this.
Yeah, that makes sense. You can sort of hedge your bets. Let's talk about another thing that we may see some activity on, and that is transfer pricing issues. Particularly, I'm interested also in advanced pricing agreement programs that states might look at. Can you sort of comment on that? What do you think might happen in 2023 and beyond on that issue?
Yeah, I mean, that's interesting. I mean, it's interesting in some regards that the MTC sort of pulled its committee, but on the other hand, I think that they, in a sense, did do their job in terms of helping educate, helping the states with their audit programs. I think states have gotten comfortable with what they're doing, whether or not it's necessarily the perfect way of auditing. And we've seen at least 3 states come forward with some sort of program. I would not be surprised to see more of that develop. However, the service is sort of led on that they're looking into this area of APAs as well, and into some of the regulations. And so more may be coming out of the service. And I imagine that states will be interested in that as well, and maybe even taking a little bit of wait and see approach before doing much more tweaking on their ends.
Right. And with respect to Indiana, obviously that state developed, I think it's a formal APA program that taxpayers can use. Do you think that people are going to sort of take a look at that and see how well that works, how much use or demand there is before deciding whether it might be of interest for states to follow in Indiana's footsteps?
I do think they would be looking at that and seeing, does it work? Are taxpayers coming forward? I imagine taxpayers will be curious to the extent that they can find it out, how it's working for other taxpayers as well, and think of it as consideration. And I would also say, just because a state doesn't have a program doesn't mean they couldn't approach the state with a proposal if it was something that one needed, certainly around you're trying to close out a set of years anyway, and maybe have done so with a service. Why not or take a run with it with the states as well?
Right, because it's possible to set up sort of informal agreements. Indiana just sort of set up a formal approach that kind of laid out how it would work, correct?
Yeah, an audit closing letter or, something within an audit or, something volunteered, sure.
Support for this podcast is provided by SafeSend. The lack of qualified candidates continues to cause issues in the profession, but progressive firms are empowering admin with tax automation software to do the heavy lifting. The SafeSend suite will save your admin staff hours on assembly, delivery, and e-signing of tax packages, saving money and making staff happier. And your staff deserve the sweet life this coming busy season. Schedule a demo to experience this workflow automation solution for yourself at safesend.com. That's safesend.com.
Let's shift topics to something kind of unrelated to what we've been discussing previously. Maybe not totally unrelated, but looking at sort of incentives, tax incentives for businesses or incentive deals. The passage of the CHIPS and Science Act provided billions and billions of dollars in subsidies to shore up specifically domestic microchip manufacturing. And we've already seen some activity by states and localities trying to set up deals with semiconductor businesses to get fabs and factories built in a given area, which obviously anytime you have an incentive deal, there's potential benefit to the business and the locality and the state, and obviously also some risks as well. Do you think we're going to see more activity on that? And if so, what are some of the policies that states might be offering?
Yeah, I definitely think there already has been more activity, honestly. I think in terms of, the energy type credits or the green type credits, we've already seen some states sort of confirm or tweak their programs to make it known that the federal eligible programs will be eligible for their existing programs as well. And, sort of strive to whatever they enact or tweak that it's in line with these federal programs so that a taxpayer could potentially qualify for both the federal program and the state program, especially if it's, kind of close in principle to what the state was already trying to achieve. Certainly the states are going to want to compete for this spending in their states as well as the jobs that come along with that.
Yeah, and obviously there have been, before sort of high profile deals that have not necessarily fallen through, but that didn't turn out the way that they were intended to. There have been some obviously that have fallen through. Do you think states and local governments have gotten better at designing these deals so that they're sort of looking at the back end, or maybe that's the wrong term, but that they're hedging, they're offering a lot, but they're also making sure that they're not on the hook for too much unless the company delivers?
Well, let me just say this, that when a taxpayer is going to make an investment like this, it's real money being spent and real facilities being built and people being hired and all of those. And things don't always pan out for whatever reasons. There can be economic reasons, there can be other reasons, on a macroscopic business level for things may or may not pan out. And I think that the states are pretty good at recognizing that, yes, programs can be the perfect program, but taxpayers aren't 100% driven by these programs necessarily. So it is a careful consideration by both parties here. As long as everybody understands that these programs aren't put into place lightly, and these types of decisions from a business perspective are not made lightly, then I think that the states will continue to try to have programs that are appealing to businesses, and then businesses need to be able to count on those programs to make the right investments.
So that's definitely something for state and local governments and businesses to keep in mind when working out incentive deals. But let's take a look at sort of another trend on the opposite side of the ledger, where you have localities actually looking to increase taxes, either on businesses or just expand their base to raise revenue or capture certain activities. There's been a rise in action by cities and counties to capture more revenue. Particularly, I think we've seen cities on the West Coast that have been looking and moving to adopt local income taxes or taxes on executive compensation. I think that there is even a ballot initiative pending qualification in Multnomah County in Oregon that would actually try and tax capital gains on the local level. Can you comment on that trend? Is that something that you think might continue to spread?
I think that the local taxes area, especially things like the examples you just gave are an area that many of us have been watching for a while. So yes, I do think it's going to continue into 2023. That being said, it's also an area that we've kind of been watching for a while and saying it's going to continue for a while, and it has been. How quickly or how much it spreads outside of maybe these more Western states, I think is a little bit yet to be determined. We're seeing some challenges in the areas, and obviously, depending on how, for some of the business taxes, where maybe there's been a component that rests on, whether people are located in a certain city or something in that matter. And then, of course, we had what everyone faced with a pandemic year sort of maybe potentially change the tax base for certain companies, or maybe even for everybody. So I do think that on the one hand, localities are continue to look for ways to expand the tax base and raise revenues, and maybe take note of some of the newer business models that are out there, and feel the need to sort of, drive revenue from that source. On the other hand, I think something like the pandemic with the remote working potentially changing a tax base is a reason to give very careful consideration to exactly, how do you come up with a tax base that's least volatile, promotes doing business in the city or locality, and really kind of drives things economically that are desired as well. So it's a little bit of a lessons learned and maybe informing how to go forward. But if I were to speculate, I would speculate that we'll still continue to see this trend.
And when you have local governments passing things like income taxes, that creates challenges to taxpayers above and beyond just the actual increased tax burden. I did a story recently on how a number of governments in the Portland region worked to update their tax codes to adopt the state's apportionment rules in an attempt to sort of simplify things, or at least that was one of the things that they were trying to do by taking that action. When you have local governments that are trying to shore up their base, maybe they're seeing property taxes decline because of increased remote work that has emptied out offices and ended leases or something like that, and they think, well, let's go after income by the corporations that operate in our area. It's not as simple as just flipping a switch, right? They have to consider that they're sort of moving into a territory that traditionally has been dominated by much larger geographical entities like states, and now they're bringing the complexity of complying with unique income tax codes down to the local level. Is that a problem?
Yeah, I mean, you raise a really interesting question, and I think it's sort of around, it may seem simple to adopt, a particular, tax regime, and it may feel as simple as a cut and paste or copy paste from a state statute or something like that. And with this thought, well, there's already a well-developed body of law. The thing is that none of this is simple, right? None of this came into being overnight. It all evolved over a very long time, and with resources and people dedicated to interpretation, whether you're talking about the service or whether you're talking about the state level, and many different states, and evolve sometimes many different ways. And so if there's going to be something that's beyond the simplest tax system, then there need to be the resources there at the jurisdiction level to deal with the questions, administration questions, the processing ability, and then disputes and interpretation, because that is just part of what comes with more complexity. So it's definitely a balancing act. When one could potentially sympathize for the need for revenue, but I think the other part of that equation is the responsibility that comes with putting into place a particular taxation regime.
Yeah, it's sort of one of those situations where you're gifted an apartment complex, but now you also have to take over all of the hurdles of administering it, managing it, et cetera. So it's a potential income generator, but it's also a huge responsibility. Another thing that localities are doing that I think you had mentioned is looking at sort of specific activity taxes. So we've seen disruptive industries pop up. Everybody knows about app-based ride-hailing companies, but you've also got delivery companies, grocery companies, et cetera. And I think we've seen localities take a look at those and I'm sort of curious, you think we're going to continue to see that trend? And is that about replacing tax revenue that used to come from one base that's now sort of been disrupted by these new industries, or is that just another effort to increase revenues overall?
Well, I suppose on one hand, there's a little bit of concern as to, if there's going to be increased traffic, for example, in the area, or increases of a certain type of service, is there going to be an increased burden on the city? And, I guess you could theoretically get into these debates as to whether these are fees or taxes. And of course, fees have to be very specific to a certain program. And there's a whole body of law around that we're don't have time to talk about today. I certainly think they could be looked at as, okay, well, here are these new businesses and we're, missing out if we don't register them and tax them in some way. But it also there could be regulatory, concerns with just wanting to know what's out there, and sometimes a fee that comes along with that. So I think it kind of feeds a little bit into what you were just talking about in terms of, a complexity of the taxation scheme. Some of these can be fees that are or fees or taxes that are relatively low, but then you just get into the administrative hurdle of, if you're doing business in 1,000 cities, how do you know every single one of these cities, and have these cities made it easy to comply? Or are you dealing with sort of old-fashioned websites or making up forms, have nobody to call? And, there's, with the states complying at the state level, we have systems and software and all kinds of good stuff. It just gets more burdensome first to even find out about the tax, and then to be able to easily comply with it. So, and it could be, for depending on the size of the business, it needs to be something that's taken into consideration. But sometimes the definitions of what's being taxed in and of itself isn't necessarily what companies feel like they are doing. And so there can be a true knowledge gap there.
As we're looking forward to 2023, are there any other topics, any other areas of policy activity that you think people listening should keep an eye out for?
I think we've done a pretty good job. We've been talking a lot over the past few years about remote work, and I think that will continue to be a thing with developments and litigation and hopefully, guidance. And then the other thing is that everyone's sort of continuing to watching, and I think there'll be, I don't know how much development will happen within the next 12 months, let's say, but certainly it's going to be an area of continued development, and that's around digital assets and things like NFTs and the impact of those, or the way to think about those from a state and local taxation perspective. So things to watch that could each probably be their own hour session if so desired.
Yes, certainly. And in fact, all of this will benefit from a substantial analysis in the coming year. But it's good to just sort of remind everyone what are some of the key issues to keep an eye on. And with that, Valerie, thank you so much for lending your expertise and your insight to us. I know we all appreciate it.
Thank you, Paul. It's been a pleasure.
And now, coming attractions. Each week we highlight new and interesting commentary in our magazines. Joining me now is Acquisitions and Engagement Editor-in-Chief, Paige Jones. Paige, what will you have for us?
Thanks, Dave. This week we're highlighting the Person of the Year as chosen by each of our magazines. Tax Notes Federal selected Senate Majority Leader Chuck Schumer as its Person of the Year, reviewing his 2022 tax policy achievements, including his role in the passage of the Inflation Reduction Act. Tax Notes State recognized Sharon Barnardi, the Executive Director of the Federation of Tax Administrators, as its 2022 Person of the Year for her trailblazing achievements in state and local tax. And Tax Notes International chose Grace Perez Navarro, Director of the OECD Center for Tax Policy and Administration, as its Person of the Year for her many contributions to the OECD over the years. And before we go, be sure to check out our opinions page, where Nana Amasarfo has examined recent tax transparency shareholder proposals, and Joe Thorndike has questioned why and when the IRS stopped auditing the president.
That's it for this week. You can follow me online at TaxStew, that's STEW, and be sure to follow at Tax Notes for all things tax. If you have any comments, questions, or suggestions for a future episode, you can email us at podcast@taxanalyst.org. And as always, if you like what we're doing here, please leave a rating or review wherever you download this podcast. We'll be back next week with another episode of Tax Notes Talk.
Tax Notes Talk is a production of Tax Notes. You can learn more about us by visiting www.taxnotes.com/podcast. When major media wants the straight story, they turn to Tax Notes. Thank you for listening, and join us again for another edition of Tax Notes Talk.
Want to see more like this? Subscribe for more tax videos. Special thanks to our executive producers Jasper Smith and Paige Jones, as well as showrunner and audio engineer Jordan Parrish.